Jeffrey, welcome back to the show. I want to first get your thought here on the idea of kind of solidifying the vaccine on our timeline. What's that going to mean for the market as we become more confident that this is real, it's coming, and it's only a matter of time?
Well, we need a bridge, right, from now till then. And we know that virus cases are rising around the world, France and Spain and Wisconsin and so many different places. We've got to get from here to there. And I don't know how far away there is. It's maybe 6 months away. So what we need to do is find a way of containing these outbreaks. And what's interesting is what we're learning from Europe. The idea that another round of lockdowns would be economically devastating, would put us right back into an economic double dip, seems to be not so worrisome for the stock market as we go through it. Europe's economy is being hit hard by the new restrictions that have been put in place in the month of November as sort of the lockdown 2.0 came into effect. But European stocks are leading the US and Asia this month. Countries like France, Spain, Italy seeing 20% gains in November, doubling the performance of US stocks. In fact, November is shaping up to be the best month for international stocks since October of 1990. And that's despite that being ground zero for the lockdowns. Very interesting. Now, do you think this is tied specifically to the idea of money kind of moving from the big cap tech? Is it more about the dollar? I mean, dollar's been declining for 6 months and we haven't had any record-breaking international months. Yeah, that's right. And so there's a little bit of dollar played into that, but I think it's the idea that what we're starting to see is more of a cyclical recovery next year. The markets have really not shined a lot of light on value stocks until this month. I mean, if you take a look at the S&P 500 value index, it's really moved sideways from May until November. And only now are investors really beginning to embrace the idea of a vaccine-led cyclical recovery next year. There are hurdles to that, but that seems to be becoming the base case. And if it is, take a look at different leadership in the markets. You know, I think we're going to start to see more international outperformance. Economic growth, GDP growth is expected to be stronger in Europe than the US next year. Earnings growth expected to be stronger in Europe than the US next year. It's been a long time, Oliver, since we've seen that. So I think that'll come together with this new cycle to really play into a revival of valuations and a lot of behavioral and fundamental aspects to help lift those stocks. One last point on this is that we're starting to see this in the flows. So flows to US equities picked up a little bit, but to international equities, ETFs, and mutual funds have really started to surge. We're seeing that across the industry and even in the data here at Schwab. So it seems that the valuation story here is playing out, right? I mean, these are areas where the economy has been beaten down, maybe have not snapped back as much as ours has in the surprising rate at which it has. So there's that idea of kind of growth rebound, but the cheapness also at which a lot of these international businesses trade even pre-COVID, right? I mean, this was kind of a turning point in rotation people were looking for at previous instances that never really manifested itself in a lasting way. We had the trade war, other things that kind of made it complicated, but one could argue that this has been a spring coiling even before COVID, could they not? Absolutely. You know, there's certainly been a case you could make on valuation alone that would have supported international outperformance for years now, as you point out. But I think we never really see that switch flip until we get a global economic downturn, until we get a global recession. You know, leadership tends to last for many years, even a decade before reversing. It usually switches between the US and international stocks and growth and value at the start of a new economic cycle. For example, after international stocks outperformed in the 80s, the 91 recession saw the switch flip back to US outperformance. And then the 2001 recession saw a switch back to international outperformance. Then, of course, the 08 recession flipped the switch again back to the US. And that has been the case until this new cycle has started to begin again. And really since July, we've started to, probably about April, maybe we've started to see slightly better performance out of international. It's really started to emerge here lately, along with more value-oriented parts of the market. Again, it's behavioral as much as it's fundamental. After a full cycle of outperformance, valuations, profit margins, and earnings expectations are stretched, and they need that catalyst of a new cycle to reset the clock. Jeffrey, do you look at this relative to the NASDAQ in a sense that
well, this is just beginning, and if value is going to be realized and a cyclical rotation takes hold, that we could continue to see this kind of preference for flows moving to international businesses, and I think also these local small caps as being kind of cut from that same valuation cloth in a sense? Or do you look at it and say, hey, this big move in international companies has happened, and the Nasdaq's only 3.5% off the highs? Maybe that means that we could get both of these to work at the same time. I mean, right now it looks like we kind of have to pick a little bit. What does this mean for the tech-heavy Nasdaq here? Can we get a continued rally if people are dabbling in other things finally?
I think that you can still get some performance out of technology, but it may be the boring part of technology. It may be the unsexy part of technology, like capital equipment part of technology, rather than the consumer internet-oriented part of the tech sector. Because I think businesses will start to look at the underinvestment in their businesses over the last few years and really start to put some of that money to work as they see the economy revive. And I tie it into retailers as well. You know, we got a lot of retail earnings over the course of this week. We got more this morning. And it really reflects a pretty strong consumer, which has, you know, they've shifted their spending to goods from experiences. They're COVID winners as well, just along with many of those tech names. Inventories on shelves and at warehouses have been restocked, expecting a pretty good holiday season in an attempt to avoid shortages. But a vaccine-led recovery next year could shift that spending back toward travel in the second half of the year, which could cap upward earnings revisions for 2021 for these retail stay-at-home winners. And so while consumer discretionary was a great performer this year, it's been the worst performing sector this month in the S&P 500. And instead, we're starting to see financials and industrials, two of the top three performers this month, really pull forward. And Oliver, those are the two biggest sectors of the European stock market.
Interesting. Okay, so the fundamental argument here as well for actual earnings growth, instead of just kind of speculation that, oh, they're going to bounce back or this is going to happen, there's a real potential here that lines up with the reason for it, right? That money can actually get spent in these places. And if you're looking for cheap stocks that can grow their bottom line, the bottom line part there might match up as well.
Yeah, that's exactly right. And it's been years since this lined up, but it's coming together. And one other thing I'd add is dividends. You know, we generally see higher dividends from international companies than U.S. companies, but the return of that next year seems to be on tap. And as investors across the board are looking for yield in a very yield-scarce environment, that could be another reason to reach overseas to find more attractive income in an environment where the dollar's falling. So those gains, those dividend payments actually translate back into more dollars. Could be a very attractive yield, much more attractive than even what we're seeing out of the bond market.